Hey Simon, you wrote recently that for stock markets, fear of inflation will replace fear of infection in 2021. What did you mean?
Well, Shun, the arrival of effective vaccines is a game changer. So, with the rollout of vaccines, looking through the pandemic is no longer just a hope and a prayer. It has become a high visibility prospect. And that will reduce the economic and the earnings visibility risk of investing in stocks. So, that should mean lower equities risk premiums and higher stock prices.
Okay, that's the easing of the fear of infection. But what about the fear of inflation?
We have seen the worst economic conditions since World War II, but in response, we have also seen the most aggressive fiscal and monetary policy interventions since World War II. Governments have spent deep into deficit, and that has been financed by central banks printing money to buy government bonds. For example, the US Federal Reserve expanded its M2 money supply by 24% from end February to end November. And this has in turn driven fear of debasement of fiat currencies and the potential for higher inflation in the future. Now, this fear of inflation is shown in the rise in the 10-year US break-even inflation rate, which reflects the market's inflationary expectations. Now, as you can see from the chart on the screen, US inflationary expectations have been rising together with the rally in the S&P 500 index. Now, we don't think this is coincidental. This is more likely cause and effect.
So, what you're suggesting is that investors now fear their cash will be worth less as prices rise?
That's right. And even though consumer prices have yet to rise, this fear of inflation becomes self-fulfilling in one very important aspect. The prices of assets have already been going up. And it's not just the stock market either. In many of the OECD economies, house prices are already higher than they were before the pandemic.
But that's the problem, isn't it? Stocks are not cheap anymore, are they?
That's true. But the dividend yields from stocks are still higher than what you would be getting from the relative safety of government bonds, and certainly way above zero yielding cash. And this spread between equities dividend yields and the 10-year US Treasury yield is largest in emerging markets and Asia ex-Japan. And valuations in Asia ex-Japan are significantly lower than in the US, both in terms of price to earnings and price to book ratios.
What about the US dollar?
The US Federal Reserve has been the most aggressive amongst the major central banks in terms of monetary expansion. So we do expect the US dollar to weaken further through the course of the year. The US dollar is currently, however, very oversold against a range of currencies. So there could be a counter-trend rebound. But we expect the rebounds to be limited, followed by lower lows. And this has implications for stock markets. Emerging markets in Asia ex-Japan historically tend to do better during periods of US dollar weakness than during periods of US dollar strength. For all these reasons, we are favoring Asia ex-Japan over the US market for 2021.